Welcome to Study Session 2, Types of Audit. Introduction. In this lecture, we shall examine the different types of audit. This will enable you to understand the scope of audit work. Though the most popular audit is statutory audit, there are many other types of audit which can be classified either by nature of work or by method of approach to the work. Objective. At the end of this study session, you should be able to describe the different types of audit, including statutory and non-statutory audit, external and internal audit, management audit, system audit, transaction audit, balance sheet audit, interim audit, year-end audit, final audit, continuous audit, partial audit, complete audit, and personnel audit. Types of audit. Audit can be classified either by the nature of work or by the method of approach. When classified by the nature of work undertaken by the auditor, we have statutory and non-statutory audit and external and internal audit. When classified by method of approach, we have management audit, system audit, transaction audit, balance sheet audit, interim audit, year-end audit, final audit, continuous audit, partial audit, complete audit, and personnel audit. Statutory audits. These are those audits being carried out within the enterprises as a result of being compulsorily required by legislation. Statutory audits are those audits that are compulsorily required by law to be carried out within an enterprise. For example, auditing of companies as contained in the provision of the Company and Allied Matters Act 1990, auditing of banks as required by BOFID, and auditing of insurance company are all examples of statutory audit. Under this type of audit, the scope of audit assignment cannot be restricted by the management of the enterprise. In statutory audit, the rights and duties of the auditors are well provided for in the Act. Private or non-statutory audits. In private audit, it is important for the auditor to agree with the client that the terms and conditions under which the audit will be carried out. This is to prevent future disagreements. Auditors may also give an audit opinion on statements other than the annual accounts, including summaries of sales in support of a statement of royalties, statements of expenditure in support of application for regional development grants, the circulation figures of a newspaper or magazine. In all such audits, the auditors must take into account any regulations contained in the internal rules or constitutions of the undertaking. Examples of the regulations which the auditors will need to refer to in such assignments will include the rules of club, societies and charities, partnership agreements. These are performed by independent auditors because the owners, proprietors, members, trustees, professional and governing bodies and other interested parties want them, rather than because the law requires them. Private audit may extend to every type of undertaking which produces accounts, including clubs, charities, sole traders, and partnership accounts. In private audit, it is important for the auditor to agree with the client the terms and conditions under which the audit will be carried out. This is to prevent future disagreement. Auditors may also give an audit opinion on statements other than annual accounts. Advantages of the non-statutory audit. In addition to the advantages common to all forms of audit, including the verification of accounts, recommendations on accounting and control systems, and the possible detection of errors and fraud, The audit of the accounts of a partnership may be seen to have the following advantages. It can provide a means of settling accounts between partners. Where the audited accounts are available, this may make the account more acceptable to Inland Revenue when it comes to agreeing to individual partners' liability to tax. The partners may as well wish to take advantage of the auditor's services in the additional role of tax advisors. The sale of the business or the negotiation of loan or overdraft facilities may be facilitated if the firm is able to produce audited accounts. An audit on behalf of a sleeping partner is useful, since generally such a person will have little or no means of checking the accounts of the business or confirming the share of profits due to him or her. External and internal audit. External audit is an independent examination of financial statements being carried out by non-employees of the business enterprise. External audits, therefore, can be statutory or private. Internal audits are those audits that are being carried out by employees within an enterprise. Internal audit is an independent appraisal functions established by the management of an organization for the review of the internal control system as a service to the organization. It objectively examines, evaluates, and reports on the adequacy of internal control as a contribution to the proper economic, efficient, and effective use of resources. The audit approach under this type of audit is a continuous audit approach which involves examination of transactions and balances throughout the accounting period without auditing to a specific date. Larger organizations may appoint full-time staff whose function is to monitor and report on the running of the company operations. Internal audit staff are one type of control. Distinctions between external auditors and internal auditors. Although some of the work carried out by internal auditors is similar to that performed by external auditors, there are important distinctions between the natures of the two functions. External auditors are independent of the organization, whereas internal auditors are responsible to the management. The responsibilities of external auditors are fixed by statutes, but internal auditors' responsibilities are decided by the management. External auditors report to the members, that is shareholders, while internal auditors report to the management, that is directors. External auditor performs work to enable them to express an opinion on the true and fair view of the accounts. Internal auditors' work may range over many operational and financial activities as determined by management. Management audit. This is an audit approach which involves examination of management activities in order to ascertain whether the rules and regulations established by management are being properly followed. This type of audit cannot be easily carried out by internal auditors. External auditor must be diplomatic where this type of audit approach is involved. System audit. This is an audit approach which involves evaluation of internal control system established within the enterprise. The objective of this type of audit is to enable the auditor to ascertain effectiveness or otherwise of the internal control system, and also to determine whether information generated or obtained under the system can be relied upon. In practice, system audits are normally being carried out within the accounting period of a business enterprise, after which a management letter shall be issued stating the weaknesses in the system as well as the effect on the enterprise and how the weakness can be improved upon. Transaction audit. This is also referred to as vouching. It is an audit approach which involves examination of various transactions carried out by the enterprise within the period. Vouching simply means examination of evidence to support the entry of a transaction in the books. The objective of vouching is to ensure that the underlying records accurately reflect the nature of transaction. The evidence used usually consists of documents and papers such as invoices, vouchers, delivery notes, purchase order, and so on. Vouching in depth or examination in depth or testing in depth is a variation of vouching audit. It is also known as cradle to grave test. It simply means following a transaction from its beginning to its end. At each stage of the transaction, all the relevant documents are examined as well as the incidence of internal control. In practice, only a small proportion of transactions can be vouched in depth. In general, the objective of transaction audit include A. To ascertain the authorization and approval of the transactions. B. To enable the auditor to determine the costs of transactions. C. To identify whether the transactions are complete, accurate, and valid. As an example of vouching in depth, let us consider a sales transaction. The examination in depth will include the following. 1. Inspection of the original order received from the customer. 2. Tracing the transaction into the sales day book. 3. Tracing the transaction into the stock records to ensure that the sales have been deducted. 4. Tracing into the sales invoice issued to the customer. 5. Tracing the sales invoice into the sales ledger and the customer's ledger. 6. Following the transaction through the receipt of cash from the debtor and the entry in the cash book and lodgement in the bank. Vouching audit is used in every small audits where the number of transactions are not too large. In audits where the internal control system is weak or non-existent. In specialized audits such as trusts, solicitors, or charities. In big audit assignments, vouching audit approach can also be used for unusual, especially large, non-routine or one-off transactions. Balance sheet. This is also referred to as verification. It is an audit approach being normally adopted by external and internal auditor on items in the balance sheet of an enterprise. The objective of balance sheet audit is as follows: to ascertain the opening and closing balance as well as additions or disposal of items under consideration, to ascertain authorization and approval, to confirm the value of assets and liabilities, to ascertain whether the assets or liabilities are in existence, to ensure that the assets and liabilities incurred are of beneficial interest to the enterprise, to identify the ownership of assets and liabilities, to ensure that the assets and liabilities have been properly classified and presented in the financial statement. Under this approach, the auditor commences the audit by taking the balance sheet at the starting point and working back to the detailed entries to substantiate each of the items in the balance sheet. The genesis of balance sheet audit is rooted in large and multinational businesses or conglomerates with complex bookkeeping and or high computerized accounting records where controls are operated by computer programs which are changed at intervals. Because of the volume of transactions, which undoubtedly are very large, transactions are recorded in summaries, while the total of each summary is transferred to further summaries before the total eventually reach the final accounts. Such recording procedure will leave very little visible audit trail, thus making it difficult or impossible for the auditor to trace the effects of one particular entry. Where the system of internal control is strong and is being operated as described throughout the period, the auditor can place reliance on it as a basis for the preparation of reliable final accounts. If this is the case, then the auditor does not need to carry out detailed checking of transactions before he can obtain relevant and sufficient audit evidence upon which he can base his opinion on the financial statements. Thus, the auditor concerns himself with verifying each of the items appearing in the balance sheet, considering the appropriateness and disclosure of the accounting policies adopted, and also checking the effect of any changes in accounting policies, using comparative figures and ratio analysis to highlight material variations in both the balance sheet and profits and loss account, which should be subject to further investigations, reviewing the minutes of directors' meetings and noting carefully any matter which may have a direct bearing on the financial statements, checking the format and layout of the balance sheet and profit and loss account to ensure that it conforms with statutory provisions as well as the appropriate disclosure of material items in line with the provisions of the statutory and regulatory authorities and also applicable accounting standards. After all this, the auditor should be in a position to carry out his final review of the financial statements, thus forming an opinion and reporting on the truth and fairness of the position shown by the financial statements. Interim audit. This is an audit approach being carried out within the accounting period of an enterprise. Usually, interim audit is adopted when an interim account is to be prepared for the declaration of the interim dividends or for the purpose of carrying out system audit. This approach can also be adopted when the transactions of the enterprises are so voluminous such that examination of those transactions at the end of an accounting period may be impracticable. Advantages of interim audit. Fraud or errors can be easily detected before untold damage is done to the enterprise. Interim audit enables the auditor to have a better knowledge about the business transactions, thereby enhancing quality control of an audit. Interim audit enables the auditor to express a professional opinion on the examination carried out on the financial statement, which shall be considered to be of highest standard, since a thorough examination of transactions and balances will be carried out during the completed audit or final audit. It enables the auditor to complete in earnest the examination of transaction as well as balance during the final audit. Disadvantages of interim audit. Financial figures may be altered, thereby exposing the auditor to greater audit risk. Audit trend may be lost, particularly where different audit teams carried out both interim and final audit. Additional cost is involved. Year-end audit. This is an audit approach being carried out within an enterprise towards the end of accounting period of the enterprise. The objective of year-end audit is to assist the enterprise in the preparation of financial statement, to attend stock-taking exercise, and to enable the auditor to test the adequacy or otherwise of cut-off procedures. Final audit. This is an audit approach being carried out by external auditors within an enterprise, which involves examination of transactions and balances as well as the content of financial statement as a whole at the end of accounting period of a business enterprise. That is when the final account must be prepared in readiness for examination. The works carried out during the final audit are assets and liability verifications, critical review of the accounts, comparison of final accounts with underlined records. Advantages: financial figures cannot be altered because the audit assignments are carried out in a strict section. No additional cost is involved. Trend team that carried out the audit of previous accounting year has been changed. Disadvantages: fraud or errors may not be detected or prevented before until damage is done to the enterprise. Thorough audit assignment may not be carried out, particularly where the volume of transaction is so high, thereby exposing auditors to engagement risks. Auditor within an enterprise may not have better knowledge of transactions being carried out, thereby affecting quality control of an audit. Where this audit approach is adopted, auditors may not be able to meet the deadline for the completion of the assignment, especially where auditors' clients have the same accounting year end. Continuous audit. This is an audit approach being carried out by the internal auditor as well as the external auditor within an enterprise. This involves independent examination of transactions and balances on a daily basis with the objective of ascertaining the completeness, accuracy, and validity of those transactions. It is an audit where members of the audit firm are occupied continuously on the account the whole year round, or where they attend at regular intervals during the financial year. This audit approach will be adopted where the volume of transaction is huge. Advantages: it allows more detailed work of checking to be performed. Fraud or errors can be discovered and corrected more quickly. The presence of the auditor will have a positive impact on the quality of work of the company employees. Disadvantages: it is possible for figures to be altered after checking. Auditor may be influenced if they stay too long in client premises. Partial or incomplete audit. This is an audit approach in which the scope of the audit assignment to be carried out can be restricted. In other words, partial audit is private in nature. Personnel audit. This is an audit approach directed at the staff of the enterprise, which involves evaluation of personnel activities with the objective of highlighting redundancy or inefficiency for possible improvements. Summary. There are different types of audit. Statutory audits are carried out in enterprises as a result of being compulsorily required by legislation, while private non-statutory audits are carried out because owners want it. Management audit involves examination of management activities in order to ascertain whether the rules and regulations established by management are being properly followed. System audit involves evaluation of internal control system established within the enterprise. Transaction audit, also known as vouching, involves examination of various transactions carried out by the enterprise within the period. Balance sheet audit, also referred to as verification, is normally adopted by external and internal auditor on items in the balance sheet of an enterprise. Internal audits are those audits that are being carried out by employees within an enterprise, while external auditor performs work to enable them to express an opinion on the truth and fairness of the accounts. Year-end audit is an audit approach being carried out within an enterprise towards the end of accounting period of the enterprise, while final audit approach is carried out by external auditors within an enterprise as a whole at the end of accounting period of a business enterprise. Continuous audit involves independent examination of transactions and balances on a daily basis with the objective of ascertaining the completeness, accuracy and validity of those transactions. Partial audit approach is carried out on a restricted basis, while complete audit approach is used when the scope of the audit assignment cannot be restricted. Personnel audit involves evaluation of personnel activities with the objective of highlighting redundancy or inefficiency for possible improvements. This is the end of study session 2. Thank you.